market, typically we will try to play our view with mostly call option. That means that we will go ahead and buy the call option. So why such that? Because whenever underlying goes up, whenever spot goes up, the intrinsic value of the call options go up and it eventually benefits us as an option buyer. So let's understand this. So I'm navigating to option chain tool in the application, and this tool is free to use for everybody who has signed up with the app. So just sign it up from the link in the description box below or from the icon. So coming to the option chain, so let's select Nifty, Bank Nifty, or let's select one stock. Let's say Reliance. Okay, you can select any F&O script, and then you can change the expiry date if you want to, and the lot size and the rest. All the details would be auto prepped by the option chain analytic over here. So first you will get to see the premiums, the call side premium, and on the right hand side you will get to see the put side premiums. Okay, so now when you're bullish on any specific instrument, let's say for an example, I am bullish on Reliance in this case. So what is my first strategy? What comes to my mind that I will go ahead and buy a call option, which is at 8.5 rupees maybe right now. So 2460 call option, which is quoting at 8.5 rupees. I will go ahead and buy that. And once Reliance underlying goes up from 2456, let's say it goes to 2470, right? Then this option will have more intrinsic value versus the option holding intrinsic value right now, right? So intrinsic value will increase basically. So I can benefit from that. So that is first strategy what comes to my mind when I'm having a bullish view on any specific instrument. Now, what are other type of strategies and why do we need them when we have a bullish forecast on any specific instrument? So first is a long call, which is simple, plain vanilla, going ahead and buying a call option in the market. So let's say Reliance. So I am in the architect tool in the application. You can also navigate it to the architect tool from the link. So now 2460 call option I am buying at 8.5 rupees. B means buy, S means sells, and add it. So now the black dotted curve is showing us T plus N PNL, whereas the orange line is showing us the PNL as on expiry. That means if I hold this strategy till the expiry, on what level, how much profit or loss I would make in this strategy. Now, if I'm leaving my cursor over here itself, by to the end of the day, what it is trying to tell us that I might end up making a loss of 352 rupees. If I hold this strategy for 1 day, so at the same level, so let's say if Reliance remains exactly where it is, I will lose 1000 rupees to the theta, which is decaying from the option premium. If Nifty moves positive, I will end up making profit. If Nifty moves negative, I will end up losing money. Over here, my maximum loss is the entire option premium that I have paid. So 8.5 into lot size of Reliance, which is 250. That is my maximum loss in this scenario. So how much is the maximum loss? It's 2125. So over here, what is the problem with this strategy? Number one, the theta decay is hurting you day by day. More hold, for more longer duration, you hold this strategy, more loss is this strategy is going to create for you because of the theta decay. Second thing is, if something goes wrong, then the entire premium that you have paid in order to buy that option, that would be at stake. So that means you can end up losing the entire option premium when you are entering in such type of strategies. And theta is obviously again the enemy.
Hey traders, Quantsapp has simplified option trading analytics for you. Click the link in the description box below, complete your sign up process and access the most advanced option analytical tools in the entire industry. Thank you.
So what you can do, you can create a different type of strategy when you're trading such ways, specifically when you're closer to expiries. So we all know that when we are closing, we are heading closer towards the expiry, the theta starts to decay at a very fast pace, right? And which creates a problem for a lot of us. So nothing big, just go ahead and sell a higher strike price call option. Let's say 2500 call option, I'm selling it. Now what will happen by doing this? First, if you see the max loss was 2200 roughly. Now it has been reduced to 1500 because the spread difference has went down exponentially. Over here as well, if I just move the cursor, now let's say if Reliance, if it remains exactly where it is, I'll just lose 800 rupees, which is very less as compared to what I was facing a loss on the on a plain vanilla long call. So this is another bullish strategy which is bull calls correct. So benefit is theta decay, that you will not be hurt by theta over here. But what is the problem? That if Reliance moves to 25 8 25 10, then your profit also gets capped after some point, right? So if you see, this is not as exposed as the long call wherein you are getting undefined profits over here, right? Over here, the profits will be capped after some point. If you look at the Greeks, what is the Greeks? So it's just 145 rupees of theta that you are paying in this strategy, considering we are very close. So expiry is almost there. It is just 2 days away, right? So it is still better. Another type of strategy is that here you have bought one and sold one, so that creates a bull call spread. What is the ratio? If you sell more, right? I am selling more over here, or one lot of the sold leg, which is 2500. This is called as ratio. When you will do this, when you are closer to the expiry, when the theta is peaking at a faster pace. Now, what is the benefit of this strategy? Again, on the loss side, you will not lose a big chunk because the net spread, it gets converted into a credit spread, and eventually, if you see, if Reliance remains at 2500, okay, you'll make a profit of 8700. And if Reliance remains exactly where it is, 1 day away from here, then you will make a profit of 360 rupees. Why? Because the theta is positive over here. More you hold a strategy, more benefit it is going to give you, right? So over here, this is ratio spread. What you have done, you have sold additional leg in order to receive the theta benefit, the benefit of theta, which is decaying at a very fast pace. What is the sweet spot? Generally, when you are a bit closer to the expiry, this strategy works a pretty well because of the theta that is decaying. And now the problem is undefined loss. Let's say if Reliance goes to 2600, that is bullish view, right? And if you are having a bullish view and if you are making a loss when the market is going in your favor, then that might create a problem for you as a trader. So now what you can do is just go ahead and hedge this by buying another strike price call option. Let's say 2540, I am buying it. So now what will happen? It will just hedge your option strategy. You will not face a undefined loss. There would be loss, but the loss would not be undefined. Okay, so the loss would be capped at always at every given point, right? And still the theta being positive, still you will be net inflow on theta. So the catch with the butterfly is go ahead and sell the legs where you expect the Reliance to move. So whatever your target is, so now let's say in this scenario, my target is 2500. So I'll go ahead and sell the legs at 2500 and I will buy the wings ahead of that. And these are few of the bullish strategies. And obviously, if you want to learn more of such type of strategies, then you can navigate to the learn section in the application over here and just go to the strategies part. So over here you can find all the types of bullish strategies, bearish strategies. Okay, so if you click on any one of them, you will get to see all the details about that specific strategy. So do check out the strategies panel and also the architect tool in the application, and analyze your strategies and go ahead and basically construct your strategies much more better using architect and the strategies panel tool in the app.